Hi there, everyone. It's Christian here, and just going to make a new video to show everyone the portfolio construction website because it's been changing quite a bit the last few months. Been under a lot of active development. Things have been changing, things have been improving. So some of the blog posts and other videos I made earlier might be a bit out of date, and it's always good to then make a new one. So I'm just going to go through everything. So the first thing we want to do is just go to the portfolio construction website, and I'm going to just take you through everything from the front page and all the different options we have when you look at the portfolio construction insight platform. So this is the front page. What I've done here is I've changed it around a bit so that we get some headline figures up front straight away, in your face, easy to see. So what we're viewing here, what we're showing here is the last 12 months of performance on our next 10 portfolio. And the next 10 portfolio is the 10 picks that we do each week. Each weekend we up to this based on 400 companies that we follow and analyze. On the Construction Insight platform itself, you can look at all those 400 companies, and you can pick and choose and do whatever you want to do based on your own analysis. But we pick 10 of those 400 companies each week. So the numbers you see here, the 12.8, the 19.4, and 25.3, that's performance numbers based on the 10 companies that we pick out of those 400, and that's updated every weekend. So Monday morning, when the market opens, that's when you would rebalance, right? So you would, if you replaced, let's say, 2 of the 10 companies from one week to the next, you would then sell out on those 2 companies and put in 2 new companies that came in, and I know the rebalancing on the remaining 8 would also happen on Monday mornings, US time, when the markets are open there. We're also very open about the historical performance, and you can always view the historical performance by just clicking the link here, and it doesn't require you to have any account, or you don't have to sign up to do anything to view the performance that's open to everyone. So as it says, this is based on the last 12 months, and it's updated weekly over the weekends. On the rest of this front page, there's a brief introduction to how it works. One of the things we've been doing over time is to simplify the interface, make it easier to understand, quicker to glance at, and just immediately understand what we're trying to tell you. So what we've done is we've introduced a few icons. So we've got the fire icon, and we've got the thumbs up icon, and basically the fire icon we put on the top 10 companies in our list of ranked companies, and those are the companies we think have reached the end of their performance run, right? We don't think, even though they might have done really well in the past, we don't think they will be able to keep it up. We think maybe investors are expecting too much, or we expect investors to take out their money. There might be disappointing news, things like that. So those are the companies that we deem too risky, and historically speaking, they've not been able to keep the performance going. On the other hand, the next 10, so if the first 10 companies on our list of ranked companies have the fire icon, the next 10 have the thumbs up icon, and that's certainly the companies we invest in ourselves. That's the companies we recommend. That's the one we put into our portfolio. Of course, recommend is a strong word. You always need to do your own assessments, risk management, and all those things, because there's no guarantee in anything. And even though, and that's an important concept, and I'm gonna look at that a bit afterwards when we drill into some of the individual pages. That even though we're recommending or giving a thumbs up to a company, it doesn't mean it's necessarily gonna increase in price, because if the market in general is heading down, a long only portfolio won't be going up. But what we're aiming to do is always to pick those that outperform. So if things are going down, we want to pick those that go down less. If things are going up, we want to pick those that are going up more, right? So that's the alpha. That's the value add that we provide. Right, so we're open for business. So we have subscriptions, and our complete investment universe is 400, a bit more than 400 companies. And those are picked because they represent a broad spectrum of the complete market. We don't want to narrow our investment universe. We don't want to like say, okay, pick the companies based on the biggest market cap. We don't want to do that. We want to have a broad universe to pick from, because that tends to give us more opportunity to outperform. So our Pro package will give you access to all of those 400 plus companies. In addition, it will give you access to what we call a forward-looking estimate, which is our ranking analysis looking into the future. So it's our current estimate for what the future ranking of this company would be up to 9 months into the future. So the Pro package gives you over 400 companies, up to 9 months of forward-looking estimates for $29 a month, plus any sales tax or similar for your region, depending on where you live. Intermediate level will give you access to half, so 200 companies, and up to 6 months of the forward-looking estimates for $49 a month. And the starter one will do that for 100 companies, 3 months forward-looking estimates. So I'm going to explain a bit more on this as well, what the impact of having a reduced investment universe, so instrument universe, is when we look at some of the other pages. Further down on the front page, you have the weekly Paco charts that we put out. Gives you a taster for free, where we pick a few companies and we show the share price and the ranking value down here for that company. And then at the bottom, we have the blog posts, highlighted media, other details, contact details, Twitter accounts, and so forth. And of course, our mailing list, if you want to have the latest blog posts and Paco charts and highlighted media, all those things coming to your mailbox, then please subscribe to our mailing list. Subscribing to our mailing list, by the way, is not the same as signing up. Signing up gives you access to the platform itself and all the data and all the analysis. The mailing list is just, the blog posts and things like that. So they're two separate things. And all right, that was a lot of stuff on the front page. I don't want to. I hope it's sort of intuitive what these things are, but I want to spend a little bit of time explaining the difference between absolute return, relative returns, and alpha. So, but for doing that, I'm going to go to the portfolio page. You can either click here and go to it, or you can click on the portfolio construction insight link here, which will take you to sort of the insight section of the website, and then you can click on portfolios on the menu here. So that would get you to the portfolios page, and the portfolios page shows you by default the performance on the last 5 years for the active portfolio, which by default is selected to be the top 11 to 20. That's also what we call the next 10. So if the top 10 are those with the flame or fire icon, the top 11 to 20 are those with a thumbs up icon. And sometimes we call the top 11 to 20 the next 10 because they're underneath the top 10, so the next 10, right? So yeah, by default, the active portfolio selected is the top 11 to 20, and the benchmark is our benchmark portfolio. So you can swap this around. I can click here, and then the active portfolio will become the top 10 instead of the top 11 to 20. I can pick this as a benchmark as well if you want to. On the columns here, you have some performance numbers. So year to date, 2017, 2018. We can also click here to add like last 60 or 90 days and so forth, right? So pick and choose what you want to look at. I think it's more interesting to look at the graph in general, so it tells the story a lot better. And so if you were to follow the next 10 picks and rebalance based on that, you would have the performance of the active portfolio, which after 5 years grew by 86.7%. So a starting value of 100 5 years ago. So this chart is always starting at 100 and then showing you the performance from that point of view. So if I change to 1 year, right, it will recalculate, and then it will start at 100 again, 1 year back. And then in that 1 year, the active portfolio has gone up to 12.9, from 100 to 112.9, so that's 12.9%. And that's what we saw on the front page. Of course, this page here is updated daily, while the front page is updated weekly, so the numbers will be slightly out of sync till they sync up again over the next weekend. And the 12.9 is the absolute return, right? That's what the active portfolio managed to do from a year ago till today. While the benchmark, the benchmark here, because we've selected the benchmark down here, is our complete investment universe. So we could have used the S&P 500, of course. What we're doing instead, we're using the complete investment universe. So that represents all the companies that we can pick from, and our aim as any professional or serious trader or investor is, of course, to do better than the market overall, right? Because if we can't do better than the market overall, why bother, right? Then we could just put our money into a super cheap index fund and be done with it. But we want to do better than that. So it's important that we, over time, beat the benchmark. So that's what we're looking at here when we're comparing the two. So if the absolute return is 12.9 on the active one, the relative returns is the difference between the benchmark and the active. And of course, because the benchmark has been going down in the last year, it's not been able to keep its value. The relative performance, or the relative return, is what we see down here on the red one, 17.75. So from 100 to 117.75 in a year, and that's the relative returns. So that's the difference between the active and the benchmark. And finally, at the bottom here, a few stats are included, and that's showing you the alpha and the beta. The alpha and beta is calculated based on what you're currently looking at here. So this is a 1 year view. If I change this to 5 years, it's going to recalculate everything, rebase it to 100, and of course the alpha and beta is going to be different because now we're looking at 5 years rather than 1 year. I think 1 year, okay, is sometimes that's really good to look at because it might have been a good year, but 1 year is a short period of time really to make any sort of conclusions on. If you want to look at the performance of any investment strategy, you want to look at more than 5 years, or more than 1 year, like 5 years minimum, right? Or 10 years or more. So that's why it's selecting 5 years by default here on this page. And over the 5 years, the active portfolio has been delivering in total 86.7% over 5 years. And the benchmark is barely giving you anything, right? It's been pretty shit the last 5 years on the benchmark. So that's just 11.5. And the relative difference is, of course, the active minus the benchmark, right? So that's 67.4% roughly, and the long-term alpha, which is measured on an annual basis. The annual alpha over the last 5 years has been 14.9% with a beta of just under 1. With a beta of just under 1 is interesting because it tells you something about the leverage factor, for example, right? So because this is a long-only portfolio and we're not doing anything fancy, we're not buying any derivatives or options or anything, we're just investing here into the stocks of those 10 we pick. We can then, by looking at the beta here, see that we're building a portfolio which is otherwise behaving very much like the market overall, because the beta is close to 1, right? So it's sort of correlated well with the overall market. But even though we have something which behaves very closely to the overall market, we are still beating the market. And on the last 5 years, we've been having an alpha of 14.9% annual, which is I'm happy with that. So this is a tool initially I made for my own, which I'm using for my own trading, and if I can keep this up, I'm pretty happy with that. And a relative return over the last 5 years, so a bit more than 67%. I think it's pretty decent. I'm happy with that. And what you can always do if you want to have more exposure is you can use leverage, right? But I don't think the performance page itself should use leverage, because if you add leverage in here, you might artificially inflate the performance so it looks like you're doing better than you're really doing, because what you're doing instead is you're adding more risk, right? So these numbers are all shown without any form of leverage. It's just a fully invested, simple, straightforward stock portfolio, and you can make it more complicated afterwards if you want to, right? So yeah, that's the portfolio page. This is open. You can go have a look at this without signing in or signing up or anything like that. And you can play around. So let's say we look at the top 10 instead. So the top 10 are those with the fire icon, and what we tend to see is that they don't. I mean, they perform pretty much like the market overall. They've sort of exhausted their outperforming potential, and they sort of fall back into your more or less average overall market performance. So the active and the benchmark are following each other a lot, mainly, and of course there's periods when this doesn't hold, like the last since December or since the start of 2019. Top 10 have been outperforming the benchmark for sure, and if I switch to 1 year, we can see that even better, I think. Okay, maybe we need to do a little bit less than 1 year, but if you do from the bottom here, I think we should see it even better. Yeah, so you can see that the top 10 have been performing better than the market overall, but that's short term, and you always want to look long term. So over the last 5 years, the thing is, the top 10, they tend to perform like the market overall. They're not capable of outperforming. They've maybe been outperforming before they became part of the top 10, but as soon as they reach the top 10 and we assign a flame or fire icon to it, then it's too risky. It's not going to be anything spectacular. It's going to be best case scenario, just following the market overall. What you instead want to do then is focus on next 10, the top 11 to 20, as we call here. I think I'm going to change the name here. It's the next 10 here, but I haven't done that yet. And the next 10, different story, right? They tend to perform better in the market. They haven't yet reached their they still have a bit of runway, right? They still have some potential to continue to outperform. So that's why we give them a thumbs up. Right. That's probably enough on the portfolio page. I certainly hope the portfolio page is fairly intuitive if you're a trader and investor and you know a little bit about stats and you know how to interpret these things. Should be pretty straightforward, I think. The other interesting page we have here is the instruments page, and that's the one that show you the list of ranked companies, and that's also if you go back to the front page, right? So if you click here on this one, then yeah, we get to the portfolios page that we just looked at, and if instead you click on this list of ranked companies, then what you get to is our instruments page, which is what you also get to if you click on this instruments link here on the menu. This is showing you our list of ranked companies, and without signing in. So currently I'm not signed in. You're going to get historical data. So we're looking at data which is 3 months old, basically. And if you want to have the up-to-date data instead, you will have to sign in and you will have to have a subscription. The different subscriptions give you access to a different number of companies. So the Pro subscription gives you access to all of them, which is just over 400 companies. So that means if I click show all here and I've signed in with a Pro subscription, I will get 400 companies. Often you don't care about the companies way down on the list. There are strategies that you can use to get in early, but that's also something which I view as more risky, right? But you know, if you can get in early, then you might be able to catch more of the uptrend. So you know, better potential with higher risk, higher reward type of thing, right? But yeah, otherwise you would tend to focus just on the top 20, 30, whatever companies as is shown here by default. So here we can see first 10. I have this fire icon, and the next 10 we've been giving the thumbs up icon, right? And that's basically to highlight and illustrate that the ones you want to focus on are the ones with the thumbs up, making it easier for you to skip the first 10 with the fire icon and look at those next 10 with the thumbs up icon. Because I'm looking at historical data because I'm not signed in, so it says please sign in, you know, to view the most up-to-date data. So yeah, let's do that, right? Let's sign in. I'm going to click here, and I'm going to fill in my email and password, and what happens now is I've signed in with my personal email. And now I'll have the most up-to-date date here. And because I have a Pro subscription, I have 10 with flame or fire icon and 10 with thumbs up icon. And what we can also do here, we can click on these tickers or name of the company, or we can go to the menu here and we can find the same ticker there. So let's say I want to have a look at Visa, for example, right? So I'm going to click on that, and that's going to open the Visa page. It's going to show me the stock price here. Visa has been doing very well, you know, been going up for quite some time, and we have been ranking quite high for some time as well. And looking into the future, so the purple line here is showing you the forward-looking estimates 9 months into the future, because I have a Pro subscription. It's showing a slight decline in the rank, which means not necessarily that the price of the Visa stock is going to go down. It just means that we think there are other companies that might might perform better, right? So yeah, that's all it means. And if it's white, if it's shown as white, that's the same as having a fire icon. So that means that we think it's, you know, maybe it's been outperforming a bit too much, and there might be a risk of it not being able to continue to outperform. And let's look at like the last year. Let's go back a bit. So what we saw. So this is just me zooming in a bit, right? So we saw it came up here. This ranking value on here is turned white, which means it's a fire. It's basically part of the fire, the top 10 section. And indeed, the stock price didn't actually manage to move up that much. And then it went back down underneath and turned green again, which means, just as it turns down from white to green here, it's going to be part of the thumbs up package and or thumbs up section. And indeed, stock price started going up. Zooming out again, we can see that yes, we didn't really have continued outperforming, and then we just dropped down, and then indeed the price continued to go back up again. So it's interesting. That's sort of how you should think about this stuff. That it doesn't necessarily mean that the price is going to go down or anything. It just means that we don't think it's so when this ranking value goes down, it means that we think there are other companies that are ranked higher with higher potential for outperformance. All right, going back to the list again, and I'm just going to show you the spark lines here. So if you look at Visa again, just as a continued example, this graph here is basically showing you, so let me just open Visa new tab. So this here is the same sort of line as what we have at the bottom here, right? So this ranking section in the bottom here of the graph. This is the same, so this thing is green here mainly, and a little bit white and so on. That's the same as this thing here, right? And you see three white lines on this. So the middle white line is the current, like up to date, today's value, sort of, and that's the same as what we see here. So 95.6. So if you go back to the one here and look at the current, that's 95.6. So you see the number there, 95.6. That's today's value, right? And then the first white, the white line here to the left, that's looking at, that's the same, that's this value here, 95.52. That's a little bit back in time, right? So that's a little bit back, going back here a bit. And then on the white line on the right side is this one here, 93.94, which is a little bit into the future. And how much into the future? Well, we can see the dates up here, right? So this is today's date, 2019/7/19. This is looking at historical dates, so that's roughly a month back, 2019/6/14. This is roughly a month into the future, right? So this is showing you the ranking values that we think all these companies are going to have in roughly 1 month's time. And this is showing you the ranking values that all these companies had roughly 1 month back, right? And then what you can do is, so by default, this is sorted from high to low on the current date. But what you can do instead is I can sort it on the historical date. So I can click on this date. Then everything is sorted by the values it had at the historical date. And I can see, things have changed a bit. So, for example, this company here, MDLZ, used to be the top 3 company a month back. But now, since then, it's dropped down, and we can see it's got a thumbs up icon on it because it's not currently part of the next 10 group, right? So if I sort about this again, we will find the same company here, right? So this is current value. It's got a thumbs up currently. And in a similar fashion, I can sort by the future date. I will then sort of be able to see, for example, that Starbucks. So let me just sort by current values again, and we will see Starbucks just underneath, right? Just underneath the next one. So it's just after the last one with the thumbs up icon. We expect this to go up in the future on the ranking value. So we can expect this to become part of the thumbs up group, probably this coming weekend or weekend after, I would expect. a semi-Mastercard, for example, right? We expect this to keep on rising with an increased ranking value in the next month. And of course, the numbers in between these are showing you the difference, right? So between on Starbucks, it's got a current ranking value of 95.34, and in a month we're estimating that this ranking value will be 104.41. So the difference between these two numbers is 9.07, right? And that's shown in green because there's a positive difference, right? So it's on the way up. And on the historical side, we can see it's been going up for a while. So a month back it was at 87.11, currently at 95.34. So it's been going up by 8.23 in that 1 month time period, historical time period. And looking into the future, we then expect it to continue to go up. So certainly, it's fairly safe to assume that Starbucks is going to head into the thumbs up group or the next 10 section here shortly, and in a month's time, what we're basically estimating is that it will be part of the fire section, the top 10, right? Because if I sort by the future date, it's up here. There's not a fire icon currently because the icons are assigned based on the current values, but sorting by the future values, then you can see it's probably going to be up here. Of course, things change, right? But that's the current estimate, and that brings me to an interesting aspect. So if I go look at Starbucks, so open the Starbucks page. We see the share price here, and we see the ranking values, and the purple one here is the future, the forward-looking estimate. This is what we predicted ranking value of the company is going to be up to 9 months into the future. Another thing about predicting the future is that the further ahead you look, the more uncertainty it's going to be. We don't, things happen, and unexpected things happen. But based on all the current information we have, this is what we expect the future to hold for Starbucks on this ranking value side. Now what we can do is I can click anywhere on this chart, on any of the individual company pages, right? I can click anywhere on the chart, and what that will do is it will select that date, and it will show me the forward-looking estimate at that date. So let's say I click at the bottom here, right? I click at the bottom there, and what we see is the forward-looking estimate at the time of that date. So on Monday, the 36th of December 2016, the ranking value for Starbucks was pretty low. It was in red territory, which is below 50. So we see here we got white, which is above 100. Means it's part of the fire section. Green, which is below 100, and the top few of below 100 is part of the thumbs up, and all the way down to 50. Below 50, it turns into red. And these colors are there to give you like a quick, at a quick glance, you should be able to then see what sort of where is this, right? What part of the ranking, what section of the ranking list is this located in? But yeah, what I did was I clicked so that we selected the December 26th, 2016 date, and when I click that, it loads the forward-looking estimate that we created at that date. So we expected the ranking values of Starbucks to start going up at that date, and what we did, we underestimated, right? In reality, it turned out it went up more. But at least we had the direction, right? So we predicted ranking values to go up, and the ranking values did go up, but they went up more than we predicted at the time. But of course, if I look what happens moving forward, we've been underestimating the absolute value of the ranking for Starbucks, but at least we've been having the ranking direction correctly. So yeah, it's been going up, and we've been predicting this. 9 months into the future is quite a lot. 9 months into the future, and stock market related. It's quite a lot. We've been predicting, and indeed it does turn down as well. And we start predicting that it's gonna fall a little bit. I mean, at the peak here we were pretty flat on the prediction, but it does start to sort of head down eventually, and then we overshoot again. We predict too much down, and then we reach the bottom here. And we're still predicting down, and that's an example of the uncertainty of predicting the future. You can't necessarily get it right all the time. But then over time, as we get more information, we start predicting that the long-term ranking value of Starbucks is heading up, and indeed it was as well. The ranking value headed up a lot, and the stock price as well headed up. Again, don't forget that there's not necessarily a direct relationship between ranking, direction, and share price. It's all a relative measure between all sorts of companies that we look at, and it's a long-only strategy, so the market might go up and down, but you want to try and find those that give you companies that tend to go up more when the market goes up, and you want to have those that go down less when the market goes down less, so you can capture that alpha. That's a difficult concept to get your head around. I see all the time that people look at this ranking value and they think that it's sort of assume, and they sort of see some sort of pattern where they expect this ranking value to have a direct relationship with the price direction, but that's not how it works. It's not how you should read this, right? You should rather, I think it's a lot better to look at the list and understand that what this means is a list of ranked companies where we're basically expecting companies higher up on the list to perform better, with the exception of the first few, the first 10 here, which have been performing too well for too long maybe, and it's time to come back down to realistic expectations. So that's how it works, and that's how you should think about it. So I always like to look at this list as a filtering mechanism, right? You look at this list, okay, and you think, okay, I need to build my portfolio, I need to make some adjustments, I need to sell something, buy something. What should I buy? What should I sell, right? And then you use this list as an initial filtering mechanism, so you don't have to look at all the different companies, right? Because then you're wasting your time, right? You just want to narrow down, you focus your portfolio using this list as a starting place. And then based on that, you either blindly follow the next 10 here, right? Always be part of those with the thumbs up ranking, or you venture out and you try and find potential investments that might reach the thumbs up group within a little bit of time later on. So you look at the future, the forward-looking estimates instead, for example, in an attempt to capture more returns at of course the cost of it being more risky, right? That's the trade-off you always make. So yeah, you should look at the list as a filtering mechanism, a filtering tool, where you want to focus your attention towards these here with the green thumbs up. So yeah, that's the list. That's the individual company pages, and we've been looking at the portfolio. That's essentially it, right? That's what you have on this website. The other thing you have on like the index page of the Insight platform is I'm just showing you the tickers here at the top, so you don't have to click on the list. You see it straight away when you log in. And then of course you can click on these to go to the page of that ticker. And pretty much it. Other things on the site, well, you got some documentation. It should be all up to date. It's got some references to various blog posts that might be of interest. Yeah, one thing I didn't show you on the instruments page is that you can if you want to, you can click on the spark lines here, and what happens when you click here, for example, is that it will reload, and I've now moved the white line, so I'm looking at all the data because I moved it this way, and that updates all these numbers here, right? So now, as is right now, it's on 2019 111. If I click here, for example, I'll click further back into the past, so then we're looking at data from 2018 39, and in a similar fashion, I can click on the forward-looking estimate, and it will then reload with these numbers being updated to look at something further into the future than by default. So by default, it shows you 1 month in the future. Now we're looking at data that's at the end of 2019, so it's a bit more into the future. Another thing I can do is I can click on this edit icon here, and I can type in a different date, and that will sort of move everything into the past, right? So I can type in a historical date. So let's say I do last year, same sort of date last year, right? 2018. That will reload the whole page using that date as the base date, and then everything is shown relative to that before and after. And as you've seen, I can sort things up and down. And I can also sort by the difference, right? So if what you want to do is if I go to current data, so if I type in a future date, what we'll do is just give me the latest data. So it's an easy way of resetting to the current view. If I sort by the difference, I can look at what's going to change the most, right? What are our predictions? So Twitter, for example, we're predicting Twitter will massively increase in its ranking value from current value of 36.89 all the way up by 17.69 all the way up to 54.58. So that's a pretty decent increase. And this is if you want to adventure out and build your own portfolios and be a bit more adventurous, and not just pick the thumbs up section of the list. You can start doing this, right? So you can filter by the change, and then it can spot opportunities like this. Twitter looks interesting, right? So it's going up a lot. So let's click on Twitter. Let's have a quick look at what's been going on, and it's been ranked really low. Really badly, right? And this is so bad that it's been in the red, and it's gone below 0. So it's like part of the bottom 10 group. And for a period, we're all the way down to like minus. What is it? Minus 16.4. Yeah, 16.4 was the bottom for Twitter. But yeah, what looked like happened was actually the bottom as well. Price started going up from that point, and if you're at the bottom, there's like, where can you go? You can go up or you can stay there, right? Most of the time. So yeah, the price has certainly been going up from around just under 20. Been going up to almost 45. That's a good increase. So it's like more than double your money here, right? And our ranking has been going up with that. So what did we rank? Yeah, indeed. If you look at what we had as a rank, as a forward-looking estimate rank on Twitter when it was at the bottom, we indeed did capture an increase in ranking values. And the stock did also eventually start performing better as well. Currently, though, is it going to continue to go up? Well, the ranking value certainly is pointing up, and it's pointing up a lot. Like in around October 2019, we're predicting this to be around 87. That's close to 90. It's a pretty decent ranking. So maybe Twitter is a company to watch. But anyway, that's one way of using the instruments list. So you can sort by the future change, and it gives us a few interesting things to look at. GM predicted up, eBay continuing up, has been going up for a while, and Facebook as well. Facebook having a lot of potential regulatory issues, maybe, but I mean, at least the ranking is heading up, so we'll see. Yeah, we'll see. But yeah, that's one way of using it. So yeah, and then finally, just to give you, so I'm currently signing with my personal email, and that I'm at the pro package, right? So that gives me 10 of the fire icon, 10 of the thumbs up icon, but it's not necessarily that you must have the pro package to make this useful, right? You could have one of the other packages, and if I look at the subscription options here, so I'm on this, right? I'm on the pro package. How does it look if I'm on the intermediate, for example? So I'm gonna sign out. So let's just quickly look at this again, right? So here we have 10 of each, 10 of the fire, 10 of the thumbs up. I'm going to sign out, and then I'm going to sign in with another account, which is my Agora Opus account. So this, if you want to contact me, you can use this, or you can use hello. Sorry, I can't even type hello at Agora Opus to contact me if you want to email me. That's basically the same as this one. So if I sign in with this, because this sort of uses a test account, this is currently at an intermediate level, so it's got the intermediate subscription package. Right, so I sign in with my other account, which is on the intermediate subscription package, and because it gives you access to 200 companies rather than 400 companies, gives you access to the 200 biggest companies measured by market cap. The list is going to be shorter, right? So instead of 400 companies on the list, it's going to be 200 companies on the list. And that also means that you typically tend to have less of these fire icons and less of these thumbs up icons. So when the pro package gives you 10 of each, we can see that currently on the intermediate package we have 1, 2, 3, 4, 5, 6, 7 of the thumbs up, and 1, 2, 3, 4, 5, 6, 7 also on the fire icon section. But the reason for this is because the reason why we're missing 3 is simply because 3 of those companies in the fire section and 3 of the companies in the thumbs up section are part of those companies that you don't have access to because you only have access to the 200 top companies by MCAP, right? But still, you get 7 recommendations, so it's not like it's bad, right? It's still a pretty decent package. And similarly on the starter package, where you have a starter package where you have access to 100, it's going to be again less, right? How many less? Well, that depends, right? Because if we're assigning thumbs up and fire icons to companies outside of those companies you have access to, you're going to see less of those icons naturally. But I think we tend to have some anyway. I was seeing. I think currently on the starter package we get 3 of each roughly. I think it's going to change a little bit over time depending on where we assign these icons. But yeah, you would tend to get something like this. So it gives you an example of what you would be getting if you sign up for like the intermediate package rather than the pro package and so on. Otherwise, everything is the same, except for the forward-looking estimate doesn't go all the way out to 9 months as it does on the pro package. Instead, it goes all the way out to 6 months on the intermediate package, and on the starter package, it will go out 3 months. So that's how that is. Yeah, I think that's it. I think that sums it up. I'm sort of hoping it's fairly intuitive. A little bit of reading is required. But I mean, if you're a trader, if you're an investor, you should be familiar with a lot of these concepts, stats, the tickers, And then the main thing to focus on is the lists and the ranking values, and understanding what the ranking values mean, and understanding that the ranking values are there to indicate what we expect regarding performance of these companies and that performance is measured both when they go up and down, right? So things might outperform even though things go down. And there's a blog post that might be of interest. Oops, that's the wrong link. If you look at the blog post, look at all of them. There's a few trying to explain this. Like for instance, why is the indicator going down, right? And it's just trying to explain this. And here's another one. It gives you a more theoretical approach to performance, where if you have two assets both going up, one going up more than the other, then the asset going up the most, asset 1 here, is outperforming asset 2, which is going up less than asset 1. But the same happens when things are going down. If both of them are going down, asset 1 is going down less than asset 2. So it's still outperforming, right? Even though the price of the asset is going down, asset 1 is outperforming asset 2. So asset 1 should therefore also rank higher than asset 2, even though the price is going down. So that's what you need to understand, right? The ranking value has nothing to do directly with price direction, but has something to do with expected future performance. And performance is relative to everything else, and things go up and down, and that's not what we're measuring. We're measuring the relativity between these instruments, right? So that's something to get your head around. I know it's a little bit tricky sometimes to do that, but yeah, try and do that. I think that's enough for this video. I sort of hope it gave you a little intro to all the different aspects and features of the site. I don't think the site is going to change that much going forward. It's sort of feature complete now, which is also why we ended the beta period. So if you're one of the guys who signed up during our beta period, there is a coupon available to you. So if you sign in and you end up on this page, there will be like a banner appear with a coupon in there, which gives you the first month for free. So use that and get 100% off on the first month. But do it before the end of August, because that's when the coupon expires. So yeah, if you're one of our beta users, go and use that. Get yourself a free month. Keep an eye. Sign up for the mailing list as well, which is different than having an account. If you sign up to the mailing list down here, you will be getting our blog posts and all those things as well. So that's it. All right. Thank you guys, and take care.